One week, he was worth more than $20 billion. Just days later, his empire had vanished. Billions of dollars were gone, and millions of people around the world were asking the same terrifying question. How can money simply disappear? What looked like one of the safest companies in crypto would soon become the biggest financial disaster of a generation. But the truth behind the collapse was even more unbelievable than anyone imagined. It all seemed impossible at first. Investors trusted it, celebrities promoted it, politicians listened to its founder. Some of the biggest venture capital firms in the world poured in billions. The company appeared unstoppable. Yet, behind the polished image, something dangerous was quietly growing in the shadows, and almost nobody noticed until it was too late. Long before headlines screamed about bankruptcy, there was a young man who looked nothing like a billionaire entrepreneur. Sam Bankman-Fried wasn't known for flashy suits or luxury cars. He often appeared in wrinkled t-shirts, messy hair, and cargo shorts. He spoke softly, slept on beanbags, and claimed he cared more about helping humanity than becoming rich. That unusual image became one of his greatest strengths. People didn't see another Wall Street executive, they saw a genius who didn't care about money, even as he was building one of the largest financial empires on earth. But appearances can hide extraordinary risks. Growing up in an academic family, Sam was fascinated by mathematics and probability. Numbers made sense to him. Markets fascinated him because they looked like giant puzzles waiting to be solved. After graduating from college, he joined a quantitative trading firm where algorithms replaced emotions and every second mattered. It was there that he discovered something few others had noticed. The cryptocurrency market was chaotic. Prices of the same digital asset could vary wildly between different exchanges around the world. While most people saw confusion, Sam saw opportunity. Buy cheaper in one place, sell higher somewhere else, repeat thousands of times. The profits were enormous. It sounded almost too easy. He founded Alameda Research, a trading company designed to exploit these differences. Money flowed in faster than anyone expected. The crypto boom was just beginning, and Alameda quickly became one of the industry's biggest players. Success came rapidly, but success has a dangerous habit of convincing people that every decision they make is brilliant. That belief would slowly reshape everything. As crypto exploded into the mainstream, Sam realized trading wasn't enough. Exchanges were becoming the gateways to the entire digital economy. Whoever controlled the exchange controlled the flow of billions. That realization led to the birth of FTX. The timing couldn't have been better. Millions of people wanted to buy cryptocurrencies. Traditional financial institutions were still hesitant, leaving room for new companies to dominate. FTX promised speed, innovation, low fees, and sophisticated tools. Professional traders loved it. Beginners trusted it. Growth became almost unbelievable. Money poured into the company from every direction. Venture capital firms competed to invest. Billion-dollar valuations appeared almost overnight. Within a few short years, FTX wasn't just another crypto exchange. It had become one of the most valuable private companies in the world. But the real story wasn't happening on the trading screens. It was happening behind closed doors. Sam became the face of a new financial revolution. Magazine covers called him the next Warren Buffett. Television interviews praised his intelligence. Conferences treated him like a visionary. Governments wanted his advice on crypto regulation. His reputation became almost as valuable as the company itself. Then came the celebrity endorsements. Sports legends, Hollywood actors, famous comedians, and superstar athletes promoted FTX. Massive sponsorship deals appeared everywhere. Stadiums carried the company's name. Television commercials portrayed crypto as the future and FTX as the safest place to participate. Ordinary people saw these familiar faces and assumed someone must have done the homework. Surely a company trusted by global celebrities couldn't fail. That assumption would cost many people their life savings. The momentum became unstoppable. Every funding round pushed the valuation higher. Employees believed they were changing the financial world forever. Investors feared missing out more than they feared risk. Confidence spread like wildfire. But confidence is often strongest just before reality catches up. Behind the scenes, something unusual was happening. Unlike traditional financial institutions, crypto companies operated in a relatively new environment with limited oversight. Many businesses moved quickly, believing innovation mattered more than rules. FTX embraced that philosophy completely. Decisions were made at incredible speed. Billions of dollars moved daily. Internal controls often seemed surprisingly loose for a company handling customer funds on such a massive scale. Few people questioned it because everything appeared to be working. The founder was famous, the investors were prestigious, the company was growing, revenue looked impressive. Why ask difficult questions when everyone was getting richer? But hidden beneath the success was a relationship that would eventually destroy everything. FTX and Alameda Research were supposed to be separate businesses. One operated an exchange where customers deposited money to trade. The other was a trading firm taking financial risks. In theory, the separation protected customers. In reality, that line became dangerously blurred. As crypto prices continued rising, almost every risky bet looked like a brilliant investment. Borrow more, invest more, expand faster. Higher prices covered every mistake. Success created an illusion that risk no longer existed. But markets have a cruel way of exposing weaknesses all at once. Then the world changed. Inflation surged, interest rates climbed, investors became nervous, technology stocks fell, cryptocurrency prices crashed across the market. Companies that looked unstoppable suddenly found themselves under enormous pressure. Billions disappeared from digital assets in just months. But for FTX, this was only the beginning. Losses began piling up across the crypto industry. Lending platforms failed, hedge funds collapsed, panic slowly replaced excitement. Yet Sam stepped forward as the industry's rescuer. FTX invested in struggling companies. It offered emergency financing. It purchased distressed assets. Many people believed FTX was becoming crypto's central bank, strong enough to save everyone else. Ironically, every rescue made the company look even stronger, while hiding how vulnerable it had become itself. But the foundation underneath that confidence was cracking. What happened next started with a single report that almost nobody expected would change history. A leaked financial document raised disturbing questions about Alameda Research. Much of its balance sheet appeared to depend on a cryptocurrency token closely connected to FTX itself. Instead of holding large amounts of independent assets, Alameda seemed heavily reliant on something whose value depended largely on confidence in FTX. At first, many dismissed the report. Then one powerful competitor reacted. Changpeng Zhao, the head of Binance, announced that his company would sell its large holdings of FTT tokens. The statement looked simple. The consequences were catastrophic. Investors immediately panicked. If Binance was selling, what did they know? Could FTX actually survive? Social media exploded with rumors. Fear spread faster than facts. Customers rushed to withdraw their money. Billions of dollars left the exchange within hours. It became one of the fastest bank runs in financial history. Normally, an exchange should be able to return customer deposits because those assets are supposed to remain available. But suddenly, withdrawals slowed. Questions multiplied. People refreshed their screens again and again, hoping their money would arrive. Many never received it. Inside FTX, desperation replaced confidence. Executives searched frantically for emergency financing. Phone calls stretched through the night. Investors who once competed to invest suddenly refused to answer. Every hour made the crisis worse. Then came a shocking announcement. Binance signed a non-binding agreement to potentially acquire FTX. For one brief moment, hope returned. Maybe everything could still be saved. Maybe customers would recover their funds. Maybe the crisis would end before becoming a catastrophe. But hope lasted less than 24 hours. After reviewing FTX's financial situation, Binance walked away. The problems were far larger than expected. The rescue was over before it truly began. Now the market understood something terrifying. FTX didn't simply have a liquidity problem. It appeared to have a massive hole in its finances. Reports suggested that customer funds had been used in ways few people imagined possible. Money deposited by ordinary users may have been transferred to Alameda Research, where it was used for risky trading, investments, loans, and other activities. When markets rose, the system stayed hidden. When prices collapsed, the missing billions became impossible to ignore. Suddenly, millions of customers faced an unimaginable reality. Their account balances still appeared on screens, but the money behind those numbers wasn't there. The difference between digital wealth and actual cash became painfully clear. Within days, the company once valued at $32 billion filed for bankruptcy. Employees were stunned, investors were devastated, customers felt betrayed. Entire fortunes disappeared almost overnight. But the nightmare wasn't finished. As bankruptcy proceedings began, another bizarre event shocked investigators. Hundreds of millions of dollars in crypto assets mysteriously moved out of FTX wallets during the chaos. Some suspected hackers, others wondered whether insiders were involved. The confusion only deepened public disbelief. Every new revelation made the story stranger than fiction. Then a new CEO stepped in to oversee the wreckage. John Ray III wasn't new to corporate disasters. He had managed the liquidation of Enron, one of history's most infamous accounting scandals. Yet even he admitted he had never seen such a complete failure of corporate controls. His description stunned the business world. Poor record keeping, missing documentation, informal approvals, lack of basic governance, billions managed with astonishingly weak oversight. For experienced executives, it sounded almost impossible. How could a company trusted with so much money operate this way? Investigations uncovered luxury real estate purchases, political donations, venture investments, private loans, and spending that raised even more questions. Every week seemed to reveal another unbelievable detail. The company that projected discipline and innovation appeared internally to be operating with astonishing recklessness. Around the world, ordinary people paid the highest price. Students lost tuition savings, families lost retirement funds, entrepreneurs lost business capital. Some had trusted FTX because respected investors had invested. Others trusted celebrities. Many simply believed a company this large couldn't fail. They learned one of finance's oldest lessons in the hardest possible way. Size does not guarantee safety. Popularity is not proof. reputation is not protection. Meanwhile, the entire cryptocurrency industry entered a deep crisis of confidence. Prices plunged further. Regulators accelerated investigations. Investors became far more skeptical. Companies rushed to publish proof that customer assets actually existed. Trust, once broken, proved incredibly difficult to rebuild. The legal consequences came quickly. Sam Bankman-Fried, once celebrated as a visionary billionaire, found himself facing criminal charges. The same cameras that once praised his success now documented his courtroom appearances. The transformation was astonishing. In just 1 year, he had gone from financial superstar to one of the most controversial figures in modern business history. For many observers, the collapse seemed sudden. In reality, it had been building quietly for years. Every shortcut ignored, every warning dismissed, every conflict overlooked, every risk justified by previous success. No single moment destroyed FTX. Thousands of small decisions slowly weakened its foundation until one final wave of panic brought everything crashing down. Perhaps the most unsettling part of the story isn't that billions disappeared. It's how easily intelligent people convinced themselves that impossible risks were acceptable. Brilliant investors invested, experienced professionals joined the company, celebrities endorsed it, journalists admired it, customers trusted it. The warning signs existed, but success made them easy to ignore. History shows this pattern again and again. When profits rise quickly, skepticism disappears. When everyone believes prices can only go up, caution feels unnecessary. When founders become heroes, difficult questions become uncomfortable. That is exactly when they're needed most. The FTX collapse wasn't simply about cryptocurrency. It was about human nature. Ambition created opportunity. Confidence attracted capital. Greed encouraged bigger risks. Fear triggered panic. And trust, once broken, destroyed everything faster than anyone believed possible. Money rarely disappears overnight. The illusion usually does. Behind every spectacular collapse lies a long chain of decisions that seemed harmless when viewed individually. One exception to the rules, one hidden transfer, one conflict of interest, one overlooked warning. By the time the world notices, the damage has already been done. The most valuable asset in any business isn't technology, marketing, or even billions in funding. It's trust. Companies can lose money and recover. Markets can crash and rebound. Prices can rise again. But once trust is destroyed, rebuilding it can take decades, or it may never happen at all. That's why the story of FTX will be remembered long after the headlines fade. Not because it involved cryptocurrency, not because billions vanished, but because it exposed a timeless truth that every generation eventually relearns. The greatest business disasters rarely begin with villains announcing their intentions. They begin with small compromises, unchecked confidence, and the comforting belief that success today guarantees safety tomorrow. And when those illusions finally collapse, they don't just take fortunes with them, they take faith, dreams, and the certainty that what seemed impossible could never happen until it did.